Please go ahead, sir. Good afternoon, all. Pandemic, as we know that the effect of this pandemic of coronavirus is huge on market liquidity, and this disruption may go a long way. A surge in prices of commodities, increased unemployment, and decreased level of income due to pandemic is expected to increase the volume of credit sales, which is significant. Hence, there is a rising level of risk of debtors default and blockage of fixed capital investment for many players, and this may further increase the level of non-performing assets in the country. We need to look at available options and opportunities of financing for working capital and for liquidity to the corporates and especially for MSMEs and exporters to enable them to fight with such massive economic wartime situation. Factoring and bill discounting are the options to look at for this purpose, and which of course India has not used to the level as that of Europe, America and other Asian countries, and within Asia itself, and which have benefited out of such facilities and services a lot. To deliberate and discuss the issues, opportunities and challenges, ASSOCHAM is organizing second global summit, which is e-version of 2020 on factoring and bill discounting. Ladies and gentlemen, we have with us guest of honor Sri Sudarshan Sen, former Executive Director RBI. We have a special guest Sri Anshuman Mohanty, Director Ministry of MSME Government of India. Sri Vikas Kanti Roy, Managing Director Ifc Factors Limited. Mr. Peter Mulroy, Secretary General FCI Netherlands, who will present the global scenario of the sector. Dr. Niranjan Hiranandani, President, ASSOCHAM and Founder and Managing Director, Hiranandani Group of Companies. Mr. Kishore Pradhan, Summit Chairman and CEO, Global Trade Consultancy Services. Distinguished speakers are there. Mr. Sandeep Mohindru, CEO, Amban Exchange. Mr. Ravi Valecha, India Factoring, is CEO from India Factoring. Mr. Amit Kaul, Vice President, IFCI Factors. Mr. Ishan Dadhich, India Sales Head, Drip Capital, and I think already around 300 participants are already, they have joined and others are joining, as more than 1,000 participants have already registered in this. So I would like to request and invite respected Dr. Niranjan Hiranandani Sir, President ASSOCHAM, and for Founder and Managing Director Hiranandani Group of Companies to kindly deliver welcome and opening address to eminent guests, distinguished speakers and participants. Over to you, sir.
A very good afternoon to each and every one of you. It's such a pleasure to be here with all of you together on a webinar. It would have been nicer, of course, if we were able to meet together in a conference. But I guess sometimes the COVID situation also gives us an opportunity, which makes us more efficient. In the sense, I just finished another meeting 15 minutes ago, and another one maybe 1 hour before, and so on and so forth. So sometimes you do think that many times the situation gives us an efficiency of operation while each one of us are sitting in various positions. So nice to have you, sir, Mr. Sudarshan Sen, Mr. Monty, Mr. Amitabh Kaul, Mr. Ravi Valecha, Mr. Ishan Dadhich, Mr. Peter Mulroy. Thank you for being over here. The fact of credit availability and credit today is an issue which is known to one and all. We have been discussing with it, and the Finance Minister of India actually in the stimulus package actually gave a huge amount of distinction in giving a stimulus which would be from the point of view of giving additional credit to the sector. It focused a lot on the SME sector on the basis of making more credit availability to that sector. However, we are all aware that that has not been adequately reached to the end of the SME sector, but the other sectors are still in dire straits of affairs. And that is why the meeting today is going to be extremely important, because we will be able to find another avenue of credit which otherwise is not as popular. Up till now, it has been the banking system and it has been the NBFCs which have catered to the credit of this sector in terms of payments of bills that are there, and that is where a majority of the amount is taking place. However, the factoring part of it and bill discounting is an important avenue which I think we need to popularize, and we want to divert a larger amount of monies to come through this segment. Of course, obviously, the sourcing of monies for this factoring is again looked at with differences, and I think we need to discuss and debate the availability of credit for the purposes of factoring. One thing I do remember, I'm telling you my own story of maybe 40 years ago. We used to have hundi discounting which used to take place, and the banking system used to actually discount these hundis. So the hundi system worked where the person who owed the money to a supplier was willing to sign a hundi of payment of 30 days, 90 days, 120 days, and so on and so forth. And one could go to a bank and actually discount those, or even discount this through other informal methods of credit that was available. Today, that system does not exist. So we need to rethink as to can we actually indigenize this system and see whether some of the other systems should be again brought back through an amendment in the law in order to see that private funding of such factoring can also take place. The second part of it, which is more important, is the taking of risk in the case of factoring. The first part was that you do discount the bills where the person actually gives funding and finance. And the second part of it is whether the payment risk is taken up by the factoring institution. And I think that is the second part of it, is a kind of a quasi risk which adds a cost which is willing to be paid by the supplier who wants immediate cash but wants to also pass on the risk of the payment to the factoring agent. These are the two aspects of it which I think need to be done. The third part of it, which I think is extremely important, is to popularize this segment, because up till now I don't think this is ever debated in the public forum. I have hardly seen any of it in any of the newspapers, whether the business papers or otherwise, or even discussions on various forums on TV or otherwise. So I think one of the jobs which ASSOCHAM will have to do, and we will take help from each and every one of you here today, and especially Mr. Monty, because I think there will be an important part of it where I think a focus in this segment becomes extremely important, especially when we are talking about a Make in India and we want to expand the segment of manufacturing in this country. A large amount of the sales being given to various institutions and practice, we will need to take care of these issues. So these and various other problems which are there in the factoring business needs to be highlighted, and I think today's meeting will become very significant. Once a conclusion has been made, ASSOCHAM will, with your help, make representations necessary to the government in order to see how we can improve this segment, because it will add to the credit of the industry and businesses. So though government has done a large amount in various parts, especially in the SME sector, we do find that funds are still not available for the purposes of trade, business, finance, and this factoring could be an important part of it. So thank you very much for joining us today, and I'm looking forward to all the interactions which is taking place in order that we will be able to take something which the government has formulated but has not been able to take it to the next level. Thank you very much. Have a great day and keep safe, all of you, and we look forward when we will be able to get together and also meet personally. In the meantime, let's continue this webinar, which will bring us as close as possible to us digitally. Thank you very much. Thank you on behalf of ASSOCHAM for being over here.
Thank you so much, sir. Thank you so much for your kind words. And now I would like to request and invite Shri Vikas Kanti Roy, Managing Director, Ifc Factors Limited, to please give your address. Over to you, sir.
Yeah. Good afternoon to all eminent speakers and participants. Firstly, this is a good opportunity for me to be a speaker in this particular forum. Factoring is a very important financial tool across the world. So I have a small presentation. I'll start with that. Firstly, I would briefly talk about our parent company, IFC Limited, and about our company, that is IFC Factors Limited. IFC is the oldest development financial institution set up in 1948, and since then, this company is in the service of the nation. Many of the prominent corporate houses in India today have grown leaps and bounds with the financial help from IFCI. IFC is now categorized as NBFC NDSI by RBI and listed on both NSE and BSE. Coming to IFC Factors Limited, the company was incorporated in February 1996 as Foremost Factors Limited and was promoted by Mohan Group and Bank of America. Subsequently, the company was taken over by IFCI in a phased manner, and today IFCI holds almost 99.90% shares of the company. It may be noted that IFL is the first member of Factors Chain International from India, and I am thankful to Peter, the Secretary General of FCI, for his continued support in all these years. Factoring is a product which gives fast and easy access to working capital, and it is especially beneficial to MSMEs. Typically, factoring is done by way of assignment of receivables, against which money up to 90% of the receivables are paid to the seller. Notice of assignment is given to the buyer, which is duly acknowledged by the buyer, and on due date payment made by the buyer directly to the factor. The factor, after adjusting its principal amount and its charges, returns the remaining money to the seller, and this cycle continues for the next set of receivables and thereafter also. In India, factoring means assignment of accounts receivable in lieu of financing from factors, whereas in United States, as I understand, factoring is defined as selling of receivables, while assignment of receivables is termed as bill discounting. On the contrary, in United Kingdom, factoring is mostly a confidential agreement between the seller and the factor, and generally buyer doesn't know the arrangement between the seller and the factor. Though factoring as a financial product started in India way back in 1990s, the product did not gain much traction in the market, as companies preferred traditional working capital facilities from bank. However, there are certain segments, especially services industries, which did not have much access to banking facilities because traditional funding requires some tangible security. Hence, factoring being a cash flow solution are more suitable for such industries. Unlike traditional working capital funding by FCC or demand loan, factoring as a product is a more scientific instrument where funding is done based on genuine invoices raised against supply of materials or provision of services. Factoring gives easy and fast access to working capital, especially to MSMEs, who upon receipt of such funding against receivables can continue with their operations instead of waiting for the money to come from the debtor after the credit period is over. One of the major advantages of factoring is that hard collateral, that is tangible security, is not mandatory. This essentially benefits the services industry as well as MSMEs. In this context, IFL has gained some really good experience while dealing with companies in the space of logistics, ITES, etc. A typical example is that IFL's client base include tiffin company, in fact, two tiffin service providers. They are providing tiffin services to companies like Hyundai, Samsung, Flextronics, UKL. So this is the kind of reach factoring can have. Some of the big beneficiaries of factoring are MSMEs, industries in nascent stage and growth phase, services sector, companies supplying to large corporates, MNCs, and government companies. Now a little bit of the Factoring Regulation Act. It was introduced to formalize the structure for factoring in India. The most important provision of the Act was insertion of Section 8D of the Indian Stamp Act 1899, granting exemption from stamp duty on documents executed for the purpose of assignment of receivables in favor of factors. In view of such exemption, assignment of receivables in favor of factors becomes a viable proposition and gave boost to factoring. Secondly, it provides for a regulate assignment of receivables by making provision for registration that clearly defines the term factoring business as the business of acquisition of receivables of assigner by accepting assignment of such receivables in lieu of financing from the factor. Now factors are recognized as NBFC factor by RBI. Chapter 5 of the Act allows registration of the assignment in central registry set up under ASSOCHAM Act within a period of 30 days. This also establishes valid claim on the receivables by the factoring companies. The registry records shall also be available for search by the public. The debtor is having the right to notice of assignment before any demand is made on it by the assignee, and until such notice is served on the debtor shall be entitled to make payment to the assigner. So this is a very important thing. So such payment shall be discharging the debtor from his obligation unless there is a acknowledgement from the debtor and debtor is involved in the process. IFL is currently focusing primarily on MSMEs. In fact, 53% of our portfolio is MSME. Number of MSMEs in India is well above 50 million, of which hardly 10% have access to bank finance. So opportunity is ample. In fact, MSME contributes approximately 30% of GDP and 40% of total exports. It's a very, very important aspect. And this is the largest employer in the country, employing almost 12 crore people. Keeping in view the importance of MSMEs, Government of India has paying special attention to this segment and directed PSUs, government departments and corporates that MSMEs should be given money within 45 days of their supplies. Trade receivables electronic discounting system, that is TRADES, has also been introduced by Government of India to facilitate fast conversion of receivables into cash. Factoring units created either by the seller or the debtor are financed through auction, and the MSME seller receives much needed liquidity immediately. The year 2019-20 was a very challenging year with a recessionary trend across the globe, India being no exception with a decade-low GDP growth of 4.2%. The COVID-19 pandemic has posed further threats to the global economy for the year FY, for the current FY, that is 2021. Lockdown across the nation has caused a lot of disruption in the economic activity in the country. Keeping in view the deteriorating situation, Government of India has acted promptly, and stimulus package of around 21 lakh crore has already been rolled out, benefits of which are expected to be long-term in nature. One of the major relief measure government has taken is 3 lakh crore government guaranteed loan to MSMEs. These would enable MSME sector to revive and grow once the normalcy is restored. Banks and NBFCs have so far collectively sanctioned 1.28 lakh crore and disbursed 77,000 crore under this scheme. Also, rupees 20,000 crore sub-debt and rupees 50,000 crore equity infusion through fund of funds scheme into MSMEs has been announced. These are big boosts for this sector. However, challenges remain as collections of receivables slow down already being experienced in India and globally. Receivables aging and NPA levels are likely to see an increase, as rightly said by Hiranandana ji. These NPA levels are likely to see an increase from September onwards, after this moratorium period is over, though there is a talk going on that there may be a third moratorium, but what I feel it's better to go for a on-time restructuring. Anyway, banks are likely to become more conservative, especially while lending to MSMEs. And this gives ample opportunities to factoring companies to tap this segment, as this segment would look for alternative service of funding. At present, constraints are both on demand side as well as supply side. Also, discretionary expenditure is at its lowest level, I would say. However, once the normalcy is restored post discovery of some vaccine, which is expected in next 2 months probably, demand side boost would be significant. This would automatically result in capacity augmentation in the supply side also, and exactly where most of the scope lies for factoring companies. Once the pandemic is over, credit demand is expected to go up significantly, and factoring companies can play a crucial role in smoothing the liquidity in the business cycle. So I feel India would be greatly benefited if factoring is promoted by government and trade associations like ASSOCHAM in a big way in the country. Thank you. This is all from me.
Thank you very much, Mr. Roy. Now I would like to invite Mr. Peter Mulroy, the Secretary General of Factor Chain International (FCI). He comes with a lot of global knowledge on factoring, and I would like to request Mr. Peter to briefly touch upon the process of factoring, as several of the participants are the first time representing from industry. They want to understand how it works. So while you go for the global knowledge sharing with the participant, would request you if you may please touch briefly upon the process cycle, how it works. So now I invite you, Mr. Peter Mulroy, to please take your session. Over to you, sir.
Good morning, good afternoon, everybody. Can you hear me okay? Can you hear me?
Yeah.
Yes, excellent.
Yes.
Thank you. Well, first, I want to say I'm actually dialing in from the United States. I'm just on holiday here, but normally I'm based in Amsterdam, Holland. It's a real pleasure to be here. I wanted just to say, I know the coronavirus has affected all of us. I received an email this morning, just an update about what's happening in India, and I know how challenging it is here. I can just tell you that having been in California and Florida, the two probably biggest hotspots in the world right now, it's quite horrific and very extremely challenging for business. Part of my presentation today is to kind of give an opportunity to talk a little bit about where the industry, the factoring industry globally, has been recently, where we are now as a result of COVID, and where we're going. And I'll use some of the things I've learned on this because I'm on holiday actually in the U.S. I've talked to a number of people. I'll give some kind of feedback relating to what I've learned actually in the course of the past few weeks. Please, if you could go to the next slide. And just so I'm Peter Mulroy, FCI Secretary General. And just a word about FCI. We are a global association of factoring companies, so banks and non-bank financial institutions. We're nearly 400 members in 94 countries, and in India we have 8 members. And I know many of you are on the line, and I just wanted to welcome you all and thank you for for your great support and the great work that you're doing. And to ASSOCHAM, Santosh, and all my friends who are presenters today, it's a pleasure to be here. Thank you. Next slide, please. You can go to the next slide. Okay, so every year FCI accumulates the global factoring data around the world from our 400 members. We just released our annual report, what we call the FCI Annual Review. If anyone wants a copy of it, you can go into the FCI website, but it gives a very good in-depth overview of where the industry is in every aspect. And obviously, specifically at the end of the book, you can see all the global data on factoring. If you could click it one or two more times, you're going to see an arrow, please. You can click it because there's an arrow missing. So long story short, you can see the phenomenal growth story of the factoring industry. Over the course of the past 20 years, the industry has been growing on a compounded annual growth rate of 9%. Almost every year growing 9%. One of the great success stories is cross-border. If you go back to 1999, the industry was a little over 500 billion euros. The total international, so cross-border factoring, was only 3% of the total. Today, that number stands at nearly 20%. So international has been one of the fastest drivers of this growth, and it's one of the things FCI obviously takes extremely seriously in supporting all of our members globally to support and help their business relating to conduct cross-border factoring activity. Next slide, please. So this just shows you a little bit of a breakdown of our performance in 2019. You can see the industry has grown to 2.917 trillion euros. That's about a little over 5% growth. A little down compared to last year, which was a little over 6%, and the previous year it was over 9%. So it's slowed a little bit, but still positive growth. You can see on the based on the regional review. Well, first Europe, being the largest region, grew at a very healthy rate of 8.5%, followed by Asia, the second largest region, declining by minus 1.2%. This decline is predominantly due to the issues affecting the factoring industry, predominantly the trade war. And China, being the largest factoring market in Asia, obviously has a very weighted impact. So what happens in China, in a sense, happens in the rest of the region, as we all know. So yes, it's the only region that showed a decline in 2019. The Americas grew at 3.6%, the third largest region, and Africa, very healthy 10% growth. Middle East, also very healthy 10% growth. If you look at the left, you can't see the percentages, but the dark blue represents Europe. Europe accounts for nearly over two thirds, 67% of the global volume, followed by Asia, which accounts for approximately 24%, the Americas 8%, and then Africa and Middle East a little more than 1%. So those are the two smallest regions. Can you go to the next slide? This is just a snapshot of, if you break down the volume, the total nearly 3 trillion euros in volume, you can see that the largest percentage of type of product is non-recourse factoring. What does that mean? It means that you're assigning and purchasing the receivable without recourse back to the supplier. And why is that? It's very large. If you look back, I think even 10 years ago, near the time of the global recession, that figure was only 24%. And so you have to ask yourself, why has it doubled? Why has it been growing so fast? Partly because, number one, companies want to take advantage of the ability to assign their receivables and to be able to not worry about them. So, you know, because they basically the factor, the bank, FI, takes the risk of the debtor. So then they can sleep at night. They don't have to worry about the exposures under that portfolio of receivables. Also, the off-balance sheet treatment. So they're able to take off those receivables off their balance sheet, and it's a very positive accounting treatment, as we all know. There's also Basel implications to non-recourse factoring as well. I won't get into that, but these are the three drivers since the global recession in 08-09. And we will continue, in my opinion, to see a significant increase in the non-recourse field because of the numerous advantages. The purple is invoice discounting. That was a much larger figure 10 years ago. That's been coming down. The dark blue 18% is recourse factoring, and then other. Please, if you can go to the next slide. And this is just to show, yes, this is just to show the percentage of factoring done domestically and internationally. And you can see 19% of global factoring is conducted cross-border. I mentioned that before. And 81% is conducted domestically. This is the first time, the first year that I've seen a reduction in the percentage from 20% to 19%. And that is predominantly due to the trade war, predominantly due to the protectionism and the increase and rise in trade. It has affected us as well. Unfortunately, I think that's going to be a somewhat of a trend. Although I will say that in any crisis, in any financial crisis that's occurred in the course of the past 100 years, factoring has done extremely well because it is a risk mitigator, and companies typically are pushed out, especially SMEs, by commercial banks during times of financial stress because of enhanced risk. So factoring is a great accelerator to support the growth of liquidity to especially SMEs. Next slide, please. And this is just a breakdown. I mentioned this before, but it kind of gives you a visual impact. Nearly 2 trillion, 68% in Europe, 23% okay in Asia, and then 8% in the Americas. So you can see it broken down. And if you go to the next slide. This shows just the membership increase of FCI. And what's so interesting about this is if you go back to 25 years ago to 1994, over half of our membership was in the developed countries, well over half. Western Europe was the dominant region. And look at Eastern Europe in the light blue, extremely small. Now Eastern Europe, Central and Eastern Europe has become one of the largest markets in FCI. I just did an analysis. We have a region of Central and Eastern Europe, Southeastern Europe, so the Balkans and the Middle East. And that now accounts for almost 40% of our membership. It's like the crescent moon between China and the EU. And these countries are growing really rapidly in factoring. You could see here South Asia, which of course includes India, and it's also nicely growing in the lime green. So anyway, it just gives you an idea of the growth in factoring, and you know, it's a reflection of the volume as well. So okay, next slide, please. Now, this is just a snapshot of the membership in South and Southeast Asia. South and Southeast Asia is a region. FCI is divided into 6 regions. And Mr. Thompson Liu, who's based actually out of Hong Kong, represents this region for FCI. And you can see India, out of, I think it's 38 members, so 8 of the 38 is from India. But you can see here Singapore, Malaysia, Indonesia, Philippines, Thailand, Vietnam. So these are all major markets. Now, where are we seeing growth? We are seeing growth in Bangladesh. Bangladesh just recently passed a new policy on factoring. FCI was extremely involved in the implementation of that policy with the central bank, together with our friends BIBM, which is an arm of the central bank. So yes, I expect very big things from Bangladesh. We had no members only a year ago, and today we have, I think, 6 members, and we probably are going to be getting something like another 6 or 7 applications in the next 12 months. So I'll keep an eye on Bangladesh. We're very excited about it. And the other country that we're working on is Pakistan. We've been having meetings with the central bank. We've been working together with the World Bank in implementing factoring there. So these 2 markets are the key. I say, especially Bangladesh, they're far ahead with the policy now. I have to be honest, it's taken well over a decade to get this policy in place. It was one of the first trips I took as Secretary General back in 2013 when I started to Bangladesh. So we're really excited about this. And of course, India, I've been working with India. Many of you know me from my days at SunTrust Bank. It was one of our largest markets on the international factoring side because we worked with various rug importers in the United States, distributors, working with manufacturers in India and Panipat, if I remember the name of the city where they're all based. And so India has been so much great opportunity. But since the passage of the factoring law and the policy by the RBI, I really think it's a new era. And every place I have seen a factoring law and a policy put in place, I've always seen an explosion in growth. And this does not fail in any country that we have been working in. And it's nice to see in our statistics continuous growth in the last few years. So keep up the great work. And this webinar is a great representative of the interest and excitement of factoring. Okay, please, next slide. Now, I'm going to get into a little bit of my, let's say, views relating to the effects and impact of COVID. Right now, we're estimated at around a minus 6% global GDP decline. And that's based on a closure of approximately 3 months. As you know, there's talk in the US, and now I'm specifically talking about what I've heard in California and other places, that they're going to close down some of the economy. So I don't think it's going to be a hard close like it was in April and May, but I do anticipate that it's going to continuously drag the growth of the US, the largest economy in the world. So it doesn't bode well. And the question is, how much is that going to impact global GDP? And so I think that minus 6%, is a figure that may get worse. And I did see the announcement by China of growth of over 3%. It was actually quite surprising considering almost every economy is in a negative territory. I don't know how they could have such positive growth, but it's a positive sign. Certainly, we can say that China's on a rebound. So it's positive. They've done a phenomenal job controlling COVID, and we can all take a lot of lessons from the Chinese example. But nonetheless, it's still challenging in so many markets. I live in Western Europe. I think things are improving there. I'm going back next week. I hope they let me back in because I'm American. So anyway, okay, let's go to the next slide, please. Now, this is just a snapshot of one of our members, our sponsor members. So they are a IT company, and they have factoring clients, banks and non-bank financial institutions, and you can see their volume declines in total sales, down nearly 40%, wholesale, so durable, non-durable goods, the same figure, effects on electronics, transportation. Granted, this is through the end of May, but nonetheless, so we are seeing kind of, let's say, a little bit of a rebound in June, but this is a great example of the challenges. Can you go to the next slide? Now, this is just something I picked up here in the US, and this is just a snapshot of the effects of COVID on small businesses. And you can see through June, there was a sharp decline, obviously, in April and May, but there is now an enhancement and a stronger confidence coming, the opening of the economy. But now, as I said, restaurants are starting to close, hard close in Southern California, as an example. I know parts of Texas. Again, I don't think you're going to see this full closure. Positive news, New York, some of the hardest hit spots are on the rise. But obviously, we've seen the lessons of a hard close. We've seen the lessons of a opening without conditions, without the enforcement of masks and social distancing. We've seen the horrific effects of that. And so now, yes, is that going to affect people's psychology to go out? Is it going to affect retail sales? It is, absolutely. So the next is retail sales. You can see on the right-hand side foot traffic to businesses stalling out. So change foot traffic, and it's almost identical to the other slide. This gets into the discussion of the effects of the impact of the COVID crisis on retail in the United States. It's been horrific. In my 20 years working in the United States in the factoring industry, I've never seen anything quite like this moment. Every week we've had a major U.S. bankruptcy. The most recent one, JCPenney's. So one of the top, I think, 3 retailers in the United States. And it is a complete and dire situation for retail here. Now, granted, they were on a negative decline because of the evolution to e-trade, electronic retail trade. So they were going through a metamorphosis, you can say, but nonetheless, this has just only added additional salt to the injury. And you're seeing every week almost a major bankruptcy. And I can tell you the factoring industry has gotten hit, and it's gotten hit hard. I know some numerous Indian suppliers shipping to various retailers, importers, distributors. Extremely risky time. I know there have been significant losses. Some direct exposure by the Indian suppliers, some by the Indian factors. Also, the U.S. Import factors have also taken a big hit. I can tell you, I know this for a fact. I've talked to them. These are very, very difficult times. But listen, we all go through this once every decade, every period of time where we see a big significant hit. And what we see is a mass fear relating to selling, so on open account terms and taking that open account risk. And so we always see a rebound, and a significant rebound. And I did a study, and it's on our website, fci.nl, www.fci.nl. I did a study on the past 3 major economic calamities: the Great Depression, 1930s, the global recession, and also the most recent COVID. And I compared them. And it's a great story. It's a great success story for our industry. We do extremely well with industry. The industry has grown, has doubled in size. What took 100 years to get to €1 billion in volume in 2008, 1.2 billion, I think it is. Now we're at 3 trillion, 1.2 trillion. Now we're at 3 trillion, almost a 3-fold increase. It's truly unbelievable. We're in one of the best industries that you could be in. And yes, it's very difficult times. Okay, please, next slide. Now, this is just, you can see here, this is just our data via Edifactoring. You can see the most hardest hit region is South and Southeast Asia. Now, granted, most volume coming out of South and Southeast Asia is Singapore. And you know what's happening in Singapore. It's a complete nightmare relating to the major fraud cases, the effects of it's a center, a financial center. But yes, we've seen a huge drop. It's horrific. I'd never expected to see these kind of figures, followed by Northeast Asia, which again is mainly China. But the overall growth decline for the first 6 months is minus 42%. Okay. Africa, the least affected, which is so interesting. You would think it'd be so affected negatively, but somehow it's kind of kept going. And Western Europe in the middle of the road, Western Europe and Americas in the middle of the road, CE, SEE, Middle East. Okay, next slide, please. And then, so what do we have to think about in this crisis? Is our client, is the SME. We have to be prepared for fraud. We are seeing it. It's growing. It's like a 1,000-pound gorilla out there, ready to club us. We're seeing frauds all over the world right now, but obviously, especially in Asia and especially targeted in Singapore, with these trading companies that have gone out of business as a result of fraud. And these are not small companies, multi-billion companies. And we've seen a significant rise in dilution. I think as of end of April, it was up to 40%, a 40% increase. Past dues were up 160%. Now it's tapering off. I saw the recent figure, it's gotten better, but yeah, and dilution is a kind of a trend towards fraud. It's a trigger, so we have to be very mindful of it. Okay, and then money laundering. Of course, there's been a rise in money laundering. I think you've seen that in the news. So again, we have to be very cautious, and just overall commercial viability of the sellers and buyers for against bankruptcy risk. So this is just a very, very challenging time for the factoring industry. Next slide. Next slide, please. I'm just going to close just by a few points, and that is, I mean, the obvious, a 42% drop in volumes in factoring internationally. Yes, it's only a small snapshot in our FCI system, but it's typically very, very realistic in terms of the overall effect. Europe is not doing as bad, and I think it depends on what happens in the second half of the year, but they are 68% of the industry. So I do expect them to kind of support the overall growth rate at the end of the year. Yes, credit insurance lines have been extremely affected. A lot of lines pulled. I will say, I'm sure you've heard of these large government schemes to support the credit insurance industry. They have been developed in the UK, in Germany, France, Denmark, Italy. FCI is now advocating on behalf of the US government to create a shield, a credit insurance shield as well. So we are looking at that. Yes, as a consequence, risk is rising, impact on liquidity, on interest rates, on pricing. Even though inflation is very low, we do think with all this, the rise in debt in the US, it's now over 23 trillion. So more larger than US GDP. I think for the first time, I don't remember, maybe possibly since the Second World War. I'm not sure. I don't know that I'm guessing, but we're at a rate of debt that I have not seen in my lifetime, and that is going to have a trickle effect on the impact of inflation, and that is a certainty. Numerous fintechs could go out of business. Even supply chain finance programs, I have been hearing that there have been some reductions in supply chain finance lines, so reverse factoring. So it's a challenging time. Please, next slide. So if you look at last year and you include the 3 trillion euros or approximately $3.3 trillion in volume, factoring volume with asset-based lending, so non-purchased receivables finance, securitizations, receivable securitizations, reverse factoring. If you add them all up, it's well over 5 trillion US dollars, so approximately 6% of global GDP. And of course, it is going to decline this year. There's no question, but it will, based on again every past recession, it's done extremely well, and we expect 2021 to be a rebound year. We have to go back to basics. Back to basics. We have to focus on a return to control and ensuring that we are doing everything the right way. And I'm afraid that many companies are going to be affected because they let down their guard. They've done deals and transactions without the controls, and that's going to cause a problem. And you'll hear more about that in the next 12 months. So we have to prepare ourselves for increased fraud and dilution risk. Okay, next slide. I just want to say FCI has invested in a new Edifactoring 2.0 blockchain-ready platform. We started it in June. We kicked off in June, just last month. I just got on a call yesterday. It's a big investment for FCI, but I'll tell you, it's going to be a fantastic new global platform, almost like the building of a new consortia, you can imagine, with the blockchain component. There's going to be a lot of information coming out of FCI in the course of the next month, so you'll get information. But it's going to be quite positive. Please go to the next slide. FCI every year has a physical annual meeting, and of course this year, due to the risk, FCI would not take the chance of getting members infected. So we decided not to have the annual meeting. It was supposed to be held in Washington, D.C. in June. Instead, we are going to have a virtual council meeting, and if you can click it one more time, because it will show the date, the new meeting will be held on the 23rd of September, and there will be an announcement out this shortly about the meeting. Next slide, please. And lastly, the annual meeting, the physical annual meeting, we have set it up for next year in Washington, D.C., 21 to 25 of June. Obviously, I pray, and we all pray that by then things will have returned to normal and we feel confident of traveling. I would say especially to the United States, sadly, but true. Yeah, so more information on this will come out, but please, you can record this date. And that concludes my presentation. I want to thank again Santosh, Kishore, Ravi, all my friends, Sandeep, everybody. Thank you so much, Mr. Roy. It's great to see you all. And we'll move forward. Thank you.
Thank you, Mr. Peter, for your wonderful presentation and global information about what's going on in the factoring space. I'm sure that participants would be taking it very positively, that how to go forward with this particular factoring product with this knowledge from you as well. So now I would like to request Mr. Anshuman Mohanty. He's there. He's the director from Ministry of Micro, Small and Medium Enterprises. Though his camera webcam is not working, there is some technical issue. I would request Mr. Anshuman to please address your and share your points to the audience, and how the Ministry of MSME considers this factoring as a product, and how the MSME companies can take advantage out of it. What is your views, sir? Over to you, sir.
Yeah, good afternoon, everybody. Am I audible?
Yes, sir. You are audible. To yeah, you are audible, sir.
Yeah, good afternoon, everybody. Actually, as you know, right now we are going through a very bad phase. Now, as we see in the circular flow of income, there is a leakage, and that's why there is a slowdown in the economy, and we are facing a lot of problem. Now there are twofold issues with the MSMEs, like most of the enterprises. So basically, lack of credit, and again another problem is delayed payments. So delayed payments and lack of credit both are actually hampering the availability of this working capital basically. So in order to avail this working capital, we are thinking of factoring and bill discounting as a product to overcome what is lacking in the traditional system. Factoring basically, when a particular enterprise is having a receivable, and it will take time actually to get the payment for that receivable. So it will sell it to the factor and at a discount. Now now it will get the immediate payment instead of waiting for the buyer to pay according to its own payment cycle. So that is basically the concept. But what is here the problem? The basic problem we are facing in factoring is basically unless there is a credit insurance is there, or some kind of guarantee is there, factoring guarantee is there. So unless that is there, it will be very difficult for the MSMEs to garner enough confidence among the factors. Particularly as far as in the domestic credit is concerned, domestic receivable financing is concerned, already the trade receivable discounting system is there, and it has started very well, and it is now we are whatever trading problems were there, So they are being addressed to, and it is hoped that it will further actually make inroads. And uh, for that actually, and as far as export financing is concerned, here factoring actually can play a big role. But again, for export financing, factoring if we want to introduce factoring, then actually MSMEs have to get the confidence of the factors are actually, most of those factors in export financing, they are outsiders, outside financial institutions. So unless we get enough confidence from those factors, we cannot actually access the factoring products. So for that, actually, we have to set the rules, and already there is a factoring act, but unless there is a proper credit insurance and the proper this factoring guarantee, it will be pretty difficult. And that's why I will suggest that we should, before considering to move forward in factoring and bill discounting, we should actually know what are the issues basically in the export finance, and what are the roadblocks. And if actually factoring as a new via media is required, then we have to bring in the set of rules. Then only factoring and bill discounting in export financing will be successful for the MSMEs. Particularly if you see the MSME fold, it is quite huge. There are several figures of number of MSMEs. The most reliable could be that of GST figure. GST, according to GST figures, there are more than 1.2 crore MSMEs. Now, if we consider that kind of population, so factoring is very much necessary. Particularly, we are contributing to almost 40% of the exports. So that's why factoring and bill discounting, particularly for export finance, it is very much necessary. But already now what we have to do, basically we have to go for enhancing and improving the trade receivable discounting system, and also bring in the set of rules, that is, which are necessary to encourage export trade factoring. Now actually you see, just a minute. We are right now, we are facing a slowdown, and as per the recent official data, the index of industrial production it has contracted in the last quarter, and there is lack of demand. So right at the moment, it is actually our opportunity to set the games rolling, set the rules of the game rolling, and we have to actually see what opportunity, this is an opportunity. Actually, we can actually take time, and particularly when this COVID situation gets over, and we are able to find a possible vaccine or a possible solution of this problem, then actually the whatever demand, those who are subdued, it will actually flare up. And it will actually create a multiplier effect in the industry, in the economy. So there will be a lot of demand, and that will in turn increase the demand for credit. And whether our banking system, the traditional banking system, will be able to handle that much demand for credit. So right at the moment, the NPA levels are very high. So, and delayed payments are also a huge problem. So that's why factoring and bill discounting could play a major role for MSME financing, particularly for working capital finance. MSME will definitely require factoring and bill discounting. But I will again stress that for that to happen, we have to set the ball rolling as far as rules are concerned, and particularly trade factoring, the external international factoring, that has to actually garner pace as far as Indian MSME population is concerned. Thank you. Hello.
Thank you very much. Thank you very much.
Yeah.
Thank you very much, Mr. Anshuman Mohanty, for your kind words and perspectives of MSME ministry. And now I would like to request respected Sri Sudarshan Sen sir to kindly enlighten the participants and the speakers. All they are waiting for you, sir. You have been so long with the RBI and handling this particular subject, so it would be great insightful from you to hear, sir. So I request and welcome you. Over to you, sir.
A very good afternoon to all of you. I must confess that I am here more to be enlightened than to enlighten. So I really look forward to some good discussions, especially in the technical sessions. Thanks a lot, ASSOCHAM, for inviting me, particularly Mr. Parashar. Thank you very much. This is indeed a topic of huge relevance for a very long time, but it doesn't seem to have, been as Dr. Hiranandan said, really been publicized, or there hasn't been enough debate. Every once in a while, something pops up in the media and then it sort of gets buried somewhere. So in the interest of brevity, I will confine my comments to factoring, though I noticed the title of the seminar included bill discounting, but I think that's passé. We're talking factoring essentially, and with a focus on the trade receivables discounting system in particular. When almost I think 6 years ago, when a paper was written as to what were the benefits that we were looking for from the trade receivables discount system, it was hoped that the MSMEs would get instant liquidity at decent rates, and this would also save on collection costs for their receivable. They would save on collection costs. The corporate buyers would benefit by saving on administrative and processing costs. The buyers would, by facilitating this liquidity to their suppliers, could probably negotiate better terms with them in future. Lenders would be able to increase their financing operations with lower risks, as the exposures would now get transferred to the typically higher rated corporate buyers. They would get valuable information on the cash flows of the suppliers they finance. They would also be better placed to collect from the buyers, being large professional entities, in this business. Now, despite the legal framework, which is the Factoring Regulation Act, having been in place for about a decade now, and the TREDS infrastructure having been in place for what, 3 years at least, it's been running. The number of dedicated factors is just 7, and the factoring volumes are still relatively small when you compare this with the international position and some countries in particular. So I think we need to really look at what are the reasons why factoring really hasn't taken off. As Dr. Hirandani suggested, could it be lack of user awareness, especially among the 1 crore MSMEs in the country, that they're not really aware of this? Could it be that the procedures today or the documentation involved in factoring or with TREDS is slightly cumbersome and there is room for improvement there? Is factoring, finance perceived as being too costly in relation to other modes of finance? Is there a lack of serious players? I mean, there are many people who have registered on the platform, but it's not necessarily so that they are actually contributing volumes to the platform. And in terms of pricing, just sheer pricing, I mean, I would like to be enlightened in the technical discussions perhaps as to where factoring stands vis-a-vis other sources of finance, because today the banks really don't look at factoring as their bread and butter. The dedicated factors, being NBFCs, have to rely on the formal wholesale financial system for sourcing the funds. They don't have the benefits of stable, low-cost deposits. So is factoring finance really, price-wise, is it very competitive? And then there's this question about trade credit insurance. I noticed that without recourse, in Peter's presentation, without recourse financing is underpinned by credit insurance. Now, in India, I think perhaps the IRDA, which is the regulatory authority, needs to really tweak some of its norms to make credit insurance, especially in support of factoring, to be more, a reality, and to really get it off the ground. And I think there is, looking at the large volume of factoring in places like Europe, for instance, and in our neighbor China, we need to probably see what are the best practices in factoring there, which we may consider adapting to our conditions. So perhaps the ensuing technical session will answer some of these questions of mine. Some of the suggestions that I think we need to work on is what is the strike rate on acceptance of invoices once they are loaded on the TREDS platform, for example. Does it take too long? Should buyers be given a time limit after which it will be deemed that they have accepted the invoices? Should there be a system of monitoring and compliance? Should we not be encouraging reverse factoring to a large extent, especially the large public sector enterprises who are mandated to buy a certain percentage of their inputs from MSMEs? We mandate that they should be, with the approval of their suppliers, push these invoices onto the TREDS platform and thereby, get the volumes going. And the other issue is credit information. There is, I think, scope that we have different TREDS platform. We have 3 TREDS platforms, for example. Is there some way in which the credit information that gets generated through the whole process of purchasing these receivables and then waiting for collection from the buyers, can there be some kind of a software which kind of brings this all together and gives lenders or financiers a good holistic view both on the supplier and on the buyer? Another big area where I'm sure the government is already working on is linking the TREDS platform to the GST platform. The GST gives a lot of information on the cash flows of the borrower. So if these cash flows of the borrower are integrated with the invoices which are put up by the borrower on the platform, then one of the risks, fraud risk, for example, or money laundering risk, gets mitigated to the extent that we see a correlation between the cash flows of the borrower on the one side and the kind of invoices which are being put up. The other issue, I think, which needs to be addressed is how do we make onboarding of a supplier onto these platforms much more easy and smoother? I think one of the issues is around KYC, because earlier when we had the Aadhaar-based KYC, it was relatively easier to onboard the supplier using the centralized database. But now that the courts have ruled against that, is there some way we can still possibly use Aadhaar in an anonymized way, using the various anonymizations available, to use centralized KYC to facilitate the onboarding better? Another area of concern is that now that we have the Insolvency and Bankruptcy Code in place, what is the status of a factor in terms of a creditor for recourse under the Insolvency and Bankruptcy Code? Can a factor move against a buyer under the insolvency law? But actually, factors are really only stepping into the shoes of the supplier. So there could be the case that they are actually trade creditors and they're not financial creditors. But I strongly feel that an exception needs to be made, and these guys need to be treated like financial creditors and then given that recourse, because it is this strength, this threat of taking the buyer to a formalized insolvency bankruptcy process, which would improve the quality of recoveries and therefore the volumes in factoring to the benefit of the suppliers as well. Now let me just turn to some of the pinpricks which are there right now in the legislation, which our finance minister promised to sort out earlier this year. Now, from a regulatory perspective, the Reserve Bank of India has broadly aligned its prudential norms for NBFCs factors, that is those NBFCs predominantly into factoring, with the norms for NBFCs in general. except that the requirement for minimum net owned funds is a little higher for the NBFC factors. So if this is indeed the case, I think there is a good case for doing away with the requirement that only NBFCs whose principal business is factoring should carry on factoring business. In fact, factoring business needs to be thrown open to every NBFC. And it sounds strange that unless you have that volume, you can't do it. It's almost it sounds a little odd and counterintuitive. So to this end, as I mentioned, I think there is a legislative change. Section 3 of the Act needs to be amended to allow all registered NBFCs to conduct factoring business without separately registering with RBI for this purpose. Also, the Act needs to drop the requirement of principal business requirement for NBFCs to conduct factoring business. And perhaps we can just have an omnibus clause that if any NBFCs are free to do factoring business, if they take on factoring business, they need the minimum own funds of rupees 5 crore. That's rupees 50 million instead of the present rupees 20 million. So the question is that when we throw open the universe of factoring to more players, to all NBFCs in general, are we necessarily going to see a the desired increase in the volumes? Perhaps not. Perhaps we need to do much more. Another aspect is about information. I found it very difficult to get reliable and current statistics on where the factoring volumes stand in respect of India. And to that extent, I think there is a need perhaps for all the factors to come together, form a group, and then put out this information on a quarterly or whatever frequency to, part of the public needs to be educated where factoring is going, what are the issues around factoring. It shouldn't just be left to the media. I think the players, the major players here, have a stake in educating the public and putting out the information in the public domain. In the interest of time, I've kept my presentation short. To conclude, let me emphasize that factoring is a great financing solution, especially for the MSMEs, and we need to identify what are the bottlenecks. We need to suggest to government and to RBI how these bottlenecks might be removed. We need to take the best global practices while doing so. And as Dr. Hiranandani suggested, I think ASSOCHAM can take the initiative in this regard. Thank you.
Thank you very much, sir, for your enlightening address, and a lot to take away out of this webinar, out of the summit. And we are sure that your suggestions would be taken care of by all the stakeholders, particularly from the factoring companies, those who are attending here today. And also the chamber at its place will take the things forward as per your guidance and suggestions, sir. Now I would like to request Mr. Kishore Pradhan. He's the CEO of Global Trade Consultancy Services and the member of Banking Commission ICC Paris, and he represents several of the boards, and he is indeed the chair for this e-summit also. I would like to request Mr. Kishore Pradhan to please conclude this first session and present the vote of thanks to the speakers and guests of the first session as well, sir. Over to you, sir.
Thank you, Santoshji. It has been a great pleasure to have this session, and it is absolutely enlightening discussion. It is really challenging discussions what we are having in the first session. So I take this opportunity on behalf of ASSOCHAM to thank each and every panel member in the first session for coming on board and sharing their thoughts. What I've actually really appreciated here, and I must highlight it in the public also, that every speaker today has taken a personal interest to ensure that this particular webinar is successful. We have been speaking to each one of this webinar. Mr. Santosh has been trying very hard, and we already had a session individually with each of the speaker over here, and people have taken an absolutely personal interest to ensure that when we talk about the factoring, it should be communicated to the public in a positive fashion, and we should highlight the benefits of the factoring to the public and the MSME sector who can take the advantage. And if because of that intention, I am sure this webinar will be a great success in the second session also. So sir, thank you very much. Mr. Peter Mulroy, he's in US and it was quite early and we insisted that he please join us personally on this session instead of any other representative from the FCI, and he has agreed to our request. So thank you, sir. Thank you very much, sir. We have been very thankful to Mr. Vikash Kanti Roy, Mr. Anshuman Mohanty, and Mr. Sen also. Everybody has actually added positively information about the factoring and the thought process. Mr. Hiranandani has been very supportive of this event, and he has actually brought up a very important issue of creating a positive visibility for this particular product. This is such a successful and such a beautiful product, and to be honest, I have been associated with this product for more than 20 years, and it has been very unfortunate the popularity what it should have. It is still not there in India. There are many reasons, and I'm sure we will discuss those reasons in the next technical session, how we can actually highlight and create a positive awareness of this particular product in the market. Mr. Sen, thank you very much. This is the second time you have been talking on the factoring also with ASSOCHAM, and actually I'm personally thankful to you, because whatever the points I wanted to raise of allowing all NBFCs to do factoring, you yourself are actually highlighting and recommending this particular suggestion that let all NBFCs should get into the factoring without having any kind of an control on the main factoring business, or 75% of the income should be from the factoring income, or 75% of the business should be factoring business. So we are really thankful to you. I'm sure you will continue with us for the second session also. So I will request Santosh ji to take us to the second session and introduce the panelist member. And once again, sir, thank you very much for your time and for your presence and for the thoughts you have shared with us. Thank you very much, sir.
Thank you very much.
Santosh ji, over to you.
Yeah, as Kishore sir, before we move forward for the technical session, maybe have a few questions, as the system is flooded of several of the questions. All such questions cannot be addressed because of the paucity of the time and the interest of this next session as well. Would request you to please raise one or two questions that you might have gotten for Mr. Peter or Mr. Sen, please.
Okay, I'll ask one question to Mr. Peter. Peter, can you hear us?
Yes, I can. Yes.
So Peter, I mean, we know each other for almost 20 years now. So I take this liberty to ask you a very direct questions. Factoring has always been a successful product across the globe. If you see, Asia also stands in a number 2 as far as the overall statistic, the presentation you just showed. It is then we ought to also talk about the 42% of the non-recourse factoring of the entire turnover after 2019. But in India, in spite of so much efforts, it is not picking up. And the major thought process or major reason which we always see is getting the limits from the import factors situated in importers country, especially in Europe, USA, and Africa. Now there is a positive news that we are going for the 80 factoring messages into completely a blockchain environment. So that technology perspective will certainly be advantageous to all the factors in India. But do you think is there any scope of improvement, or there is some kind of a piece of advice you want to give to the factoring companies in India to ensure that the proper limits are available and we can actually get into a bigger business? So what do you suggest to the factoring companies in India and exporters from India?
Well, thank you, Kishore. And, I really appreciated Mr. Sen's presentation just a minute ago, because he touched on some really, really valid and good points as to what he views as obstacles, relating to why the industry is not growing to the expectation, and certainly the track record of many other countries. 1991, I think, was the year that State Bank of India, SBI Factors, started. It's now almost 30 years? 30 years since that time. Next year will be 30-year anniversary. Yes, the factoring law wasn't implemented until 2012, if I recall. I think the policy came in a few years later. So, but I think listen, what I see as the ingredients of success of every factoring market around the world includes a number of, let's say, factors, if I can use the word. Number one is India has the disadvantage, and I apologize, I'm going to say this, I'm just going to be blunt. India has the disadvantage of being a British colony, in the sense that, an ex-British colony, because all the Commonwealth countries practice predominantly invoice discounting. You know, the concept of a debtor management culture, for whatever reason, is diminished in many of these countries. I see it everywhere. And one indicator is international. Most international factoring is done on a non-recourse basis. But if you look at the percentages of international factoring as a percentage of domestic, as a percentage of total, it's half that of every other country around the world. This is a theme in all the Commonwealth countries. So that is just the concept of not having a strong debtor management culture. You know, Mr. Sen made the comment, most of the non-recourse factoring is done with credit insurance. That's not true. I would estimate, because we don't know exactly the amount, but I would say only half. What does that mean? It means that the other half, okay, so 1.5 trillion, 750 billion is being done by the factors themselves. They are taking that risk. They are underwriting these retailers, these importers, these distributors. They are taking what he referred to as trade credit risk. You know, it's a different conceptual credit concept that many credit departments are not familiar with, to take short-term unsecured trade credit risk. It's a new phenomenon, new direction. And I think, you know, one of the challenges that you know you have is that you have this culture of not doing non-recourse factoring, more invoice discounting, more that type of recourse factoring. You have the disadvantage of not having a strong credit insurance culture. So doing domestic deals is harder, because, to his point, you know, it's harder to get guaranteed lines in place on debtors, on buyers. And I would also say that, you know, I'll talk now about the power of the factoring association. You have a factoring association, which is great. What I've seen in any factoring association when it's formed, you know, is, and Mr. Sen was also making this point, that, you know, you do a lot of advocacy. You get divulge your true volume figures, you know, so you have an actual, you know, really true domestic and international view of what's happening. You basically attempt to provide even, you know, concepts like dilution, concepts like fraud, concepts like inform the industry what's happening. Don't be shy. Let them know. Let the regulators know. Let the, you know, become more visible. Become more. So that's another ingredient that I see as a success factor. You know, and I think the other point he made was very good. That, you know, in most countries, the commercial factors, the non-banks, are not regulated. Now, I don't believe in non-regulation. I believe in some form of light regulation. But sometimes it can be taken to an extreme. So yes, it was a very good point. And lastly is the red tape. Now this is something I can't speak of. Only you know what you have to do. But I know always that the red tape in India has been a big issue. And also the cooperation by the banks. I know you have a hypothecation on all assets. It's a big issue to kind of take out receivables out of a bank facility that they've used all the assets, encumbering all assets. That has been an issue that I've heard in the past. So, you know, but again, you know, you have to look at also the positives that you guys have done, you know, because there's a lot of positive stories as well, you know. So I'll stop there. Thank you.
Thank you, Peter. Thank you, Peter. That is a perfect explanation, and you actually raised a very important point, and I can share with you. I have actually launched this product in few MNC banks, and convincing credit guys to look at factoring proposal from the credit perspective, it's really a challenge. Bankers still look at it as a balance sheet lending, which is not, which is completely different than the balance sheet lending. It is a basically sales ledger driven lending, and that is really challenge everybody will face in the banking industry. And you can actually look at me as a first-hand experience in that, because I have been instrumentally launching this product at least to MNC bank, and it was certainly challenge. And Mr. Sen, I think that is the one of the answer. Even I wanted to give it to you, but it is coming from the Peter, that when we actually as a banker, we look at the credit proposal, it is more of a balance sheet lending. We always look at the overall the past record of the balance sheet lending. And when we actually look at a factoring as a proposal, the factoring always look at its sales ledger, and it looks at the possible future sales, and we try to purchase this receivable, setting up the sufficient limit for the future sales also. So there is always driven by the sales ledger approach rather than the balance sheet approach. Another problem, Mr. Sen, from the banking industry is we always look at the financial risk. We always look at the credit risk of the seller. But in the factoring, we have two types of risk. There is a credit risk or basic risk, or the performance risk, and the credit risk. Performance risk is related to the seller, which is our client, whether he is able to manufacture the goods in a proper fashion, and he is able to export the goods as per the order. And the credit risk normally lies with the buyer, which is much bigger entity, say in Europe or US. And that is a basic concept in factoring, and we should be actually encashing on that concept. And there are few banks and few companies who are actually taking the benefit of that and able to offer good proposals to the corporates or MSME sellers in India. So, but yes, it is certainly uh, a fact is that it is not a well-known product. Even if you talk about the factoring, you talk about trade receivable platform, it is certainly not a very well-known product in the industry. Just 5 months back, before the lockdown, I was in a small city of India, maybe tier 3 metro, and people were not about what is the trades. And actually I highlighted it to one of my friend in trades company, and people were not aware about what is the trade platform, whether we can actually sell the receivable, the problem, what is the factoring. And that particular city is known for the textile export, and in spite of that, having the export continuously for last so many years, the companies were not aware about the export factoring, which can offer a completely without recourse solution to them. Of late, we actually received a question from one of the MSME guys, whether is the trace platform is actually a without recourse platform, without recourse solution. It is a fact. And the question which was coming from was a very senior person. And see, this is the kind of an awareness we have. So I think that is what the challenge, Mr. Hiranandani also highlighted, that we need to actually do something for this. Fortunately, 2 years back, we had this similar session, and we had actually got together through on the boards of the ASSOCHAM, and we had a committee, and we have been trying hard with different regulatory authorities, IRDA, to look at this product and promote this product. I'm sure Santoshji will actually take the note of it, and we can actually start working on this again today. And we also take the points for this statistic for the uh, India factoring perspective, factoring which happens in India. Now that is a challenge, because every bank, every organization has a different way of looking at it. In certain cases where we are doing invoice discounting or bill discounting, we still call it factoring. Some may not call it factoring. So there is always a challenge identifying actual factoring business in India from the banker's perspective. So with that, I will prefer to. We are actually running out of the time. So I will again thank you all the participants, and we will be in touch, and we will actually raise the questions in the second technical session also. And most of your questions should get answered in the second session. So thank you, Peter, thank you, Mr. Sen, thank you, Mr. Mohanty, Mr. Roy, and Mr. Niranjan Hiranandani. Thank you very much. Santosh, over to you.
Yeah, thank you so much, sir, for this wonderful session. And now I would like to request and invite Mr. Sandeep Mohindru. Mr. Sandeep Mohindru, CEO M1 Exchange, to please address your kind words.
Thank you.
Over to you, sir.
Thank you so much, Santosh. I'm presenting, opening up a small presentation. Let me know if you are able to see my screen.
May you please widen your screen or show a slideshow?
One second.
We can see your screen, sir.
You can see the presentation, right?
Yeah, yes, sir.
Okay, perfect.
That's
Thank you everyone for organizing this, and special thanks to ASSOCHAM for considering factoring as a product for discussion, and very insightful comments by Mr. Peter and by Mr. Sain and all other esteemed panel members. So I was actually hearing, and the expectations and the support that is coming from default trades is very high, and it's heartening to note that TREDS is expected to solve the problem of delayed payments, and that's one of the objectives with which it has been set up for the country. Just from Mr. Mulroy's comments, yes, India is small in the factoring, and if we divide the factoring into two parts in terms of export, international factoring for international business from India and the domestic factoring. On the domestic factoring front, many steps have been taken in the last 2 years by RBI, a regulator, and in context with TREDS, and some positive developments, some offshoots have started coming. The adoption has gone up multi-notches. However, as Mr. Sain suggested, there are many points still to be covered on the ground, and the growth in the volume can be much larger. All the suggested points in terms of anti-money laundering, duplicity issues that Mr. Mulroy is expecting, those points have been built in more strength, have been given with more strength, and controls have been built in the TREDS platform. I will reflect that in my slides. IRDA Insurance has come out with a paper for factoring, and hopefully in the next 2 to 3 months, the insurance companies are hopeful to launch it. As Mr. Sain suggested, liquidity has to be brought in onto TREDS exchange more and more because the requirements are high. Our Honorable Finance Minister has already announced in a budget speech that NBFCs will be allowed. We are expecting notifications and release with that. Having said that, I'm going to cover some of the statistical points about TREDS, its adoption, its reach within the India, and like our other friend said, that many of the MSMEs are beginning to realize what TREDS is all about, and some of them are still unaware how we are reaching in India and how many cities we've reached in India. I'll cover some of these in my slides. To be able to appreciate that today in the domestic market, if you have to carry out traditional bill discounting or factoring, what all is expected from a seller? Seller has to source his own limits. Seller sources these limits based on his own creditworthiness. He has to source an NOC from a bank to be able to use this product. He has to get his own invoice approval. He has to manage the collections from the buyer on the due date and get it to the bank who has funded for him. So all this role is expected from a seller. If there is any delay in the repayment, then the seller, in all possibilities, in case of recourse with recourse factoring, he has to bear the risk of repayment and penal interest as well, which has been very high in the traditional factoring in India. The financiers have always run a risk of potential fraud, as Mr. Mulroy said, and therefore they implement large scale of audits. So all of this brings limitation to the scale so far, because bank limits are finite, because they are basis the creditworthiness of the seller and not of the buyer. Banks have to have a branch network because they have to evaluate hundreds and thousands of SME enterprises in tier 3 and tier 4 cities as well. Seller's bandwidth is always limited because he's not transferring the risk of collection in a non-recourse factoring. Financier is always doubting the authenticity of the approval that the seller has brought from a buyer, and seller always carries in his thoughts his previous collections will come on time or not come on time. So all of this leads to a high cost of business, and these are some of the points which came up as Mr. Sain also said in the white paper that RBI released about 5 years ago, basis which TREDS was carved out. And this is when what TREDS have done so far. So it went live in 2017, and this is actually a trade receivable marketplace. So when I say marketplace, a seller really doesn't have to go from bank to source limit. This is his credit potential. He gets all these limits from the banks. And since the launch of 2017, the change which has happened in the country is that today all 35 banks, large banks in India, are participating on factoring on the TREDS exchanges, and NBFC factors so far are interacting. NBFCs may follow. So therefore, in the last 24 months, about 20,000 crore has been funded by these 35 banks, and approximately 12,000 plus enterprises have benefited by this funding. Just to give you a flavor of the banks, the banks have now created a TREDS desk. These banks these TREDS desks are mostly either centralized or at regional level, and they are not into branch banking. The banks are evaluating a handful of corporates and funding. As I said, thousands and thousands, more than 12,000 SME enterprises have already been funded. Just to give you a very, very high level view on how we have made it digital. Here, the supplier doesn't have to worry about taking a credit limit on himself. He just has to post the invoice, the buyer approves the invoice, and basis that approval, all the 35 banks are available to the supplier for bidding to buy that invoice. And once the bid is accepted by the supplier, the payment is credited the next day morning. So this whole process takes one full day vis-a-vis the earlier days where it has been happening manually, and getting the approval from a buyer is manual process. Getting the paperwork with a financier is a manual process, and it takes at least few weeks before the credit hits him versus one day, which is happening on TREDS. Further, the collection on the due date is done by the bank himself through an automatic route by use of TREDS as a mechanism. So that supplier nowhere now has to worry about his collection. It's a complete non-recourse. That means there is no recourse on the supplier. He's passed on the credit risk. So this is a very high level view on how the transaction works, so that you are able to understand and benefit from the future slides. Now, having said that, some of the problems which it has solved is that the risk has been transferred to the financier by the supplier in this ecosystem. This is very beneficial. The working capital, which is stretched out for both the large buyers as well as the suppliers, when you're transferring the risk, it is giving you a confidence to do more business. Now, both the buyers and suppliers, the business is becoming very competitive because the cost of doing business has come down by almost 5 to 6 percentage points, and I will reflect in my upcoming slides the rate of interest which the MSME suppliers are getting on TREDS. You will be surprised to see in upcoming slides, it ranging between 6% to 11%, and actually most of it is between 6 to 9.
Wow.
So because the cost comes down for the supplier, the overall cost of doing business is reduced. Many to many relationships is the favorite thing because it's a marketplace. The supplier doesn't have to worry about signing multiple documents. This whole system is limitless in terms of relationships, supplier, buyer, and bank. And the limit sanction has been taken care of by the banks on the large corporate and not on the supplier. Therefore, the limit is not finite for a supplier. This is a reflection of some of the rate of interest which the suppliers are getting. If he's supplying to a AAA rated corporate, the rate of interest is as low as 6%. If he's supplying to a AA rated corporate, it's sub 8%, and to a A rated corporate is sub 9%, and BBB is sub 9.5%. So this is the average rate of interest which the supplier is getting, basis which the overall cost of doing business is reduced dramatically. As I said, now expanding into the multiple states because this is digital. And we checked out into that suppliers are logging in from how many cities in India. And we were pleasantly surprised that from 352 cities, suppliers have logged in and discounted their invoices. The largest one have been the West region, which has given a coverage to 113 cities, followed by North and by South of 98 and 95 cities. And 60% of these suppliers and the funding has gone to tier 3 and tier 4 cities, which personally I feel that in a normal scenario, in a physical scenario, so many suppliers getting a coverage in tier 3 and tier 4 cities of such kind of a product may have taken a lot of effort from a branch banking perspective, and the kind of rates that we are reflecting, the kind of liquidity they are getting. And amongst the three categories of micro, small and medium, 90% of the financing has gone to micro and small. So really speaking, it has enhanced the reach. As I said, it's limitless in terms of funding, in terms of its reach. Now it's picking up speed, especially in the post-COVID time. Practically, the exchange has been live, the funding has been happening, the bills have been getting discounted, even in April, May, June, and in July, it has zoomed. I mean, the numbers have come to pre-COVID levels for the exchange. I'll reflect how is it different amongst the various points that I've mentioned so far, so you're able to appreciate it. Just give me, this will be a small 30, I would say about 60-second video. Let me know if the voice is reaching you.
Sandeep, we can't hear anybody.
You can't hear the volume?
No, there's no sound. We can see the slides very clearly, but not the sound. Can't hear anyone.
Okay, let it be. Then I'll continue to run the slide.
Yeah.
So these are, I'm sorry for the sound was not there, maybe because I mean I could hear it, but it could not reach you. So these are some of the points by which Trades has picked up, and what we have done so far, 20,000 crore. I'm sure same time next year, the number will be much more different because we are seeing the adoption and the adaptability both at the large corporate end as well as the SME end. PSUs are taking time to adopt it, but the private sector is all over it post-COVID, I must admit that. Happy to comment more and put a perspective if there are any other points.
Thank you.
Thank you very much, Sandeep Mahindru sir. Now I would like to request and invite Mr. Ravi Balecha, CEO, India Factoring Financial Services Limited, to please give your presentation.
Santoshji, Santoshji, if you allow me, can I ask some questions to Sandeep ji?
Sir, may we have the questions after all the presentations are over?
Sure, sir. Sure.
If you allow, please.
Absolutely, sir. Absolutely,
yeah.
absolutely.
So I think participants would be more, they will be taking one by one. We will be having questions from the participants also, and in that session.
Sure.
So Ravi Balecha sir, over to you.
Yeah, good evening, everybody. Thank you, ASSOCHAM. Thank you, Santosh, and the panelists, the co-panelists, and the esteemed members who presented earlier. Thanks for this webinar, and it's a pleasure always to be associated with ASSOCHAM. This is the second event where we are participating with ASSOCHAM, and rightly so. Have a small presentation for quick reference for everybody, where we will showcase what we are and what we offer in the market. So India Factoring, can I go to the next slide, please? We are a subsidiary of FimBank operating in India as a non-bank finance company with a subcategory of specialized factor. We are also authorized dealer category 3 as under the FEMA approved by RBI, which allows us to offer international factoring. So unlike the earlier comment Mr. Mohanty mentioned about the offshore factorings not being licensed in India, not operating but operating in India, we are licensed fully to operate in India with 2 licenses under the non-bank finance company license and the authorized dealer category 3 license as well. We are also rated in India as A2. This has changed. We are, as I mentioned, we are a subsidiary of FimBank. Our primary focus in India is offering export factoring, which is on a non-recourse basis. Next slide, please. As I mentioned, we are a subsidiary of FimBank. FimBank itself is a trade finance specialist bank. It's not a commercial bank or not a wholesale universal bank, unlike what banks we have. It's a niche bank in itself with a specialization in entire gamut of trade finance activities, with specialization in shipping finance, forfeiting, traditional trade, and also factoring businesses across Europe, Middle East, and in India through us, and with one entity in Egypt as well. Next slide, please. Next, Santosh, I've gone through this. Thank you. Yeah, so we were set up, India Factoring has been there in India since 2009 when we were incorporated. We had been into, through our license, a gamut of products earlier. The regulation itself came about, for the factoring regulations came about in 2012. Thereafter, the reforms from the RBI also came about in 2014-15. But we have been in existence since 2009 and were offering a multitude of products earlier. Since 2015 or 16, we changed our complete strategy with a focus completely on offering factoring products in India. That is both domestic and exports factoring. Currently, we are rated as currently with our volumes, which we ramp up through FCI's export factoring platform. We are leaders in the Indian factoring market with a market share of 45% in the international factoring. Next slide, please. So I'll not go through the much in detail because the product is known to everybody. We offer the traditional trade, domestic factoring as well as export factoring. Focus more on the export factoring. The beauty of the product, Santosh, can you go through the next slide? Is the beauty of the product is that it's a non-recourse on the exports front. It's with recourse on the domestic front. Both the product offerings are on an unsecured basis, so we don't require a security for offering the factoring product. The other benefit of factoring, as has been highlighted earlier, is it's an off-balance sheet particularly from a without recourse. So it's a balance sheet effective treatment for the customers as against the bank offerings, which is loans and advances. This is a pure sale of receivables, and the Factoring Regulation Act permits the true sale, and it's categorized as a true sale for us from an India context point of view, and also enables us chasing the buyers and recovering the payments. Mr. Sain mentioned that under the insolvency, whether we will be able to chase out to the buyers. If not in the legality point of view, but we have experience in recovering from the corporates and in recovering from the buyers under the Factoring Regulation Act. It enables us to recover the money from the buyers. In international, some geographies, it also enables you to recover from the buyers. And if there is an instance of buyer making a payment directly to the seller, in some geographies, you can also recover and make the buyer pay twice as well. So that's the beauty of the factoring product in the international and Indian markets. Next slide, please. From benefits point of view from the clients, I mentioned it's not just the financing tool. Mr. Sen also mentioned about the pricing part of it. While I would say factoring is not really an apple-to-apple comparison from with the bank lines or post-shipment or pre-shipment finance, or even from a domestic point of view, because you are offering a multitude of products, a multitude of features of the factoring, which is not just finance. It is also underwriting the buyer risk coverage. So you are stepping into the shoes of the, in Indian parlance, you can say most of the exporters are required to take an ECGC cover. So you are providing that service as well. You are providing the collections facility also. None of the banks in the post-shipment finance provide the collection facility and recover the money from the buyers. Through our correspondent factor network, we are providing both these services, that is credit protection as well as the collection service, which is a far better proposition and a holistic situation. So all put together, I would say factoring proposition is a bundle up of unsecured finance as against the bank finance, which is almost always a collateralized finance. It's non-recourse for exports. It provides buyer risk coverage and also provides collections facility. Just to give you a perspective, sitting in India, imagine you are to reach out South America, where the language will be a constraint. Peter himself is in US, almost 10 to 12 hours of difference. So that is a difficulty which the client or the supplier faces in Indian markets. Through our correspondent factor network, through FCI, we are able to fulfill that gap and provide that services also to the customer. So besides all these features, that is a balance sheet effectiveness also is there. And what better than in a current scenario, what we are going through, which is a global pandemic. In the global pandemic, there is a huge liquidity crisis, which is having a drain on the balance sheet of most of the corporates. Now, obviously, while the regulators are providing their moratoriums and whatnot facilities to enable the suppliers to tide through this challenging period, from the balance sheet perspective only, when a corporate has taken a factoring vis-a-vis a banking product, the difference is much different because it does not reflect as a borrowing on the clients, and hence the effect of loans and advances is not there, and enables the corporate or the SME to have a leaner balance sheet with a little impact from the current situation also. Next slide, please. The differences I've gone through, of course, just a reiteration. It's it's a true sale of receivables against a bank line, which is more of a hypothecation or of a collateral back lending. Factoring is off balance sheet in case of non-recourse. Even in case of recourse, it is a contingent liability which is carrying on. Whereas in case of a bank limits, which is a balance sheet, it reflects in the balance sheet as a loan. It's unsecured, and bank lines are mostly secured. In a factoring, receivables get converted into cash, and in case of bank, it continues to remain as debtors while the loans and borrowings also reflect. Factoring, as we talked, from a credit perspective, factoring is more on the dependent on the future sales or on the sales turnover, past history of the sales, the vintage with the client enjoys with the buyer. These are the comfort factors from the credit perspective, whereas a bank is almost always on the balance sheet back, which is where it needs to have, the client needs to have a healthy balance sheet to procure a balance sheet, to procure finance from the banks. Whereas in case of factors, it's not just a function of balance sheet, it's a predominant requirement is more on the sales side of it. So performance of the risk remains on the client's credit worthiness. In case of a bank, it's completely on the client's worthiness. The buyer's credentials are not at all regarded in case of banks. In factoring, we are also providing collections. Banks never provide collections facility. Penalty is not there in case of export finance. Penalty is always there in case of bank finance. We have a more of a buyer concentration approach from a factoring perspective, whereas it's always a client-focused approach for the banks. Next slide, please. Santosh, go on. The model probably is everybody is aware about the model, both the domestic and the exports. With this, I'll end the presentation, citing that we continue. This is the second year, 2019, where we continue to be the leading factor in India. purely from the sales turnover point, from the factoring turnovers point of view, under FCI's two-factor mechanism, the numbers show that we are 4th largest in Asia and 11th largest across the world. Thank you so much.
Thank you so much. Now I'd like to request Mr. Amit Paul, Senior Vice President and Head Marketing and International Factoring India IFCI Factors Limited, to please give your presentation, sir.
Good afternoon, everyone. I hope I'm audible.
Yeah.
Yes. Thank you so much. And good morning, Peter Mulroy, my Secretary General FCI, my very good old friend of Bankcam, SunTrust, and CIT days. It's a pleasure and honor. Mr. Sen, pleasure and honor to welcome you, sir. My Managing Director, Mr. Bakash Kanti Roy, and everyone, all esteemed members, Mr. Kishore Pradhan. It's been a very enlightening session. Thank you so much for for the enlightening session. Now, I would like to start my presentation by giving a view about my company, as well as taking into consideration that most of the participants in the audience are the MSMEs. So let's begin. Yeah, the first slide. Can we go to the next slide, please? About IFC Factors. Just go back, please. We are a wholly owned subsidiary of IFCI Limited, which is the oldest development financial institute of the country and a Government of India undertaking. IFCI Factors, being the first NBFC factor in India, has a deep understanding of SMEs and MSME industry and its customers. We are also the pioneers of export factoring in India and the first member of Factors Chain International in India way back in 1997 when we started export factoring. We have a pan-India presence in all the metro cities, and all across the country we have presence, and we offer our domestic and export services. Basically, our prime products are domestic sales bill factoring and purchase bill factoring, as well as export factoring with credit cover from FCI member import factors across the globe. Last but not least, we also offer short-term corporate loans against tangible collaterals. Can I go to the next slide, please? So those of who will not be aware of what is factoring, most of the audience in the MSME sector, well, factoring provides funds based on the strength of the debtor and strength of the transaction between the client and its debtor or the buyer, rather than on the collaterals or the strong financials of the borrower. So this is the beauty of the product factoring. You know, what happens is mostly these MSMEs and the SMEs all over the globe, they, you know, whenever they go for a loan to the banks, they are always asked to first give collaterals, so the collaterals are not available. So first and foremost, we analyze the debtor, because if they are dealing with big debtors like government companies like Navratnas, Maharatnas, Mini Ratnas, or big MNCs, or for that matter, big corporate houses. So the debtors are strong, the transaction is analyzed, and if we find it satisfactory, then the client is onboarded and becomes a factoring client. We don't depend on the financials of the client, of the MSME clients. What are the advantages of factoring? Number one, we can, you know, the client gets cash upfront of up to 90% of the total invoice value post shipment. No or minimal collateral or security is required. The credit terms are very competitive. And last but not least, the appraisal mechanism is very fast as compared to the banks, and the sanction as well comes in within 30 to 45 working days. That's the normal which is there in the factoring industry in BFC factors. Next slide, please. Why do we need factoring? It's an easy and fast access tool for working capital MSMEs. Higher percentage of receivables funded up to 90% of the total invoice value. Normally it's 80%, but we can go up to 90% depending on case-to-case basis. And the best part is, sir, the collateral-free receivables finance. So no collaterals are required. Invariably, that's the best part, and that's why the MSME industry, which is starved of funds, they are the best. They are the beneficiaries of this product. The other benefits are it converts your receivables into instant cash. Those MSMEs which are working in manufacturing and service sectors, and those MSMEs in the nascent phase, even the startups with 6 months to 1 year of history, or in the growth phase who want to expand their business, but they get stuck up. So they come to the factors, and we are there always to help them and convert their receivables that are stuck up for 60 days, 45 days, 90 days into instant cash. So as I mentioned, the target MSMEs are those which are dealing with large corporates, MNCs, and government companies. Next slide, please. How factoring works? It's a since it's a technical session, I just thought I will share a small workflow. So what happens? Your customer approaches you and gives the invoice to you, a copy of the invoice to you, and 80 to 85% of the or 90% of the invoice payment is made by the factoring company to you. Till now, the debtor is not involved. A copy of the invoice, of course, has been received by him. On the due date, the payment is collected, and from the customer makes the payment on the due date to the factor, and the factor collects the payment. The 20% balance payment is paid to the client, SME client, minus the charges which are incurred, discount charges or service charges. So that's how the entire process is. Factor comes in as an intermediary. It gives upfront cash 90 days or 60 days in advance, whichever is locked up. So that cash can be utilized for your working capital, for expanding your business, for your payrolls, for making raw material purchases, things of the sort which are required by MSME. And at times what happens, if you want to expand your business, you get more debtors, more buyers, but you don't have working capital to buy raw materials. So that is the time when this product comes in hand, and it's a continuous process. So you can add more debtors once you are set up, and those debtors which are again big debtors will be automatically loaded, and your it's a growth phase will be smooth. And in the last 20-25 years that we have been doing factoring, there are many clients who have moved on, who started as micro or small industries, and today they're out of the SME sector and they don't need funds from us. So that speaks volumes. MSMEs have started 20 years back with 5 crore turnover. They have crossed 250. They were with us for about 20 years. So it's a continuous process. Once you start a relationship with a factoring company, it becomes like you keep on adding more debtors, you keep on expanding business, and your receivables convert into cash instantaneously, and you just fill it and forget about it. That's how it moves. Next slide, please. As has already been mentioned by many of my esteemed panelists, about 30% of India's GDP is from the SME and the MSME sector, which is quite substantial by all means. And more than 40% of India's total exports are attributed to the MSME sector. That's phenomenal if you can by going by any gauge, and over 12 crore people are employed by this industry, MSME. So that's the one second, I am getting some very important point to be noticed is that SME growth rate has maintained an average rate of over 10% consistently over the years. At times it has gone up to 11, 12, 13% also. So the SME industry is a very important part of our economy, with 30% of India's GDP, with a phenomenal growth rate, and more than 40% of the exports turnover comes from that SME industry. Now, what are the problems they are facing? Let's go to the next slide, please. It's working capital. As everyone knows, working capital is the lifeline of any SME or MSME industry. And efficient management of working capital is imperative for growth. However, working capital often gets locked up in receivables, impacting cash flows. Even if there are big buyers, at times the payments get delayed, and the entire working capital cycle gets badly affected. So the traditional means of raising working capital are shareholder funds, overdraft financing, leasing, equity finance, trade finance. But now the factoring comes into picture as a savior. Next slide, please. See, before I go to the factoring part, the challenges which MSMEs are facing in raising working capital. Number one, I would read out the fourth point as number one: lack of availability of collaterals. So most of the MSMEs have insufficient fixed assets to pledge, and the shares are unlisted, which may not suffice for debt. Next is nil or negligible performance history. So all the MSMEs or SMEs which are either new or just came into operation recently, they have a negligible history of, the track record is very, very negligible, which cannot be analyzed. So the credit lines are not granted by the banks. And there is no market information about these MSMEs. So since in absence of the market information, it is very challenging to verify what sort of client-buyer relationship has been there, and how the debtors are there, what sort of promoters are there. So it becomes very difficult to analyze and grant funds to them by the banks. Next slide, please. So I was discussing about the domestic factoring, but since many of us are aware, export factoring has been one of the main products of IFC Factors, and we have always worked very closely with FCI Factors International. Once again, our respected MD sir has already thanked Mr. Peter Mulroy. I take this opportunity, Mr. Peter, to thank you, sir, for all your support and guidance continuously extended to IFCI Factors ever since last 20 years, both in the capacity of in a different capacity, in your earlier capacity as a senior manager in various banks, and now as a Honorable Secretary General of FCI. Thank you, sir, for guiding us, and we have been doing very well. Of late, of course, there have been some problems, but we think that after the pandemic is over, and maybe 3 to 6 months' time, the opportunities will be phenomenal for export factoring, because people will be looking, as Mr. Sen said, for liquidity as well as for credit guarantee. So when we get credit insurance from FCI members, big banks like BNP Paribas or CIT Commercial Finance, or for that matter Deutsche Factoring Bank, so we get a lot of comfort, because what happens, the entire receivables are credit insured, and therefore we can offer non-recourse factoring to the exporters. As our Director Saab also told from the MSME industry, that export factoring needs to be looked at, and also the the insurance part. So I'm glad to announce that we have been participating in this FCI FCI trade two-way factoring system from last 20 years, and as I can vouch for that, there have been 2 or 3 occasions, as Peter would definitely agree, when we have been made payment under guarantee by import factor, none other than Deutsche Factoring Bank, way back in late 90s. Absolutely on dot 90th day, the money came to us when the buyer went insolvent. So that has been tried and tested. Fortunately, it never happened again. But I know, leave aside this this period of pandemic, which is going to be, it's a more of an anomaly and aberration. But once it is over, we'll be back to good times, and we will once again grow our business volumes. I'm very sure both export and domestic, and export will be totally depending upon the FCI members, because we get credit insurance. Thankful to you, Mr. Sen, for giving us the license for RBI from RBI as authorized license, authorized dealer license, as well as opportunity to do non-recourse factoring. Earlier, non-recourse factoring was not allowed, as Peter would know. Although we were doing it, in a kind of a hidden manner, but now practically all factoring, export factoring, is non-recourse, because therefore that's the only way we can get credit insurance from FCI members. So now we are doing, and we have been getting a lot of inquiries. So let this pandemic time get over 6 months or 3 months, and I'm quite sure that will be a great opportunity for the entire factoring industry, both in domestic and export, because the banks will not be forthcoming, sir. Banks will now be a bit conservative, and there'll be a lot of demand for credit. I'm sure there'll be a lot of demand for credit sales, and factors will play a very important role. So I really want to thank each and everyone in the panel, and would like to say once again that just my last slide gives the contact information. So anyone wants to contact us, they can reach us on our website. We have got online application forms, and the phone numbers and the addresses are there. So thank you very much for listening to me, and thanks a lot, everyone. Thank you. Thanks once again. Bye-bye. Cheers.
Thank you, Mr. Amit Kaul. Now I would like to request Mr. Ishant Adich, India Head Sales from Drip Capital, to please take up your session. Over to you, sir.
Thank you, Mr. Santosh. Perfect. I think this has been a great opportunity for all of us to hear the speakers present today, right? I would like to thank you all for sharing your insights, and I would also like to welcome all the people who are attending this session, right? I'm sure, like, given today, all our responsibilities are divided even at home. So thank you for taking this time out to join us and hear our thoughts around factoring. Thank you, Mr. Peter. I know this is an odd time that you have joined, right? But this is really sweet of you to join in and share your thoughts on this, right? And Mr. Sen, I was actually Googling about you when we started the session. You have been even pivotal in terms of how factoring, or like most of us are in business today, right? I'm going to be representing Drip Capital. I'm going to be speaking about how factoring today possibly is like the internet of 90s, right, for MSMEs. Can all of you guys see my slides? Is my perfect. Amazing. So first, let's actually speak about what is this sector that we are actually speaking about, right? Why are SMEs today important from any perspective today, right? So SMEs today typically contribute about like 30% to our GDP, right? And India, like, I'm sure like all of us are proud about it, right? India today has the second largest base of SMEs in the world, right? We stand at about 65 million SMEs today, right? And this sector actually creates 110 million jobs, right? Anup, have you taken the control back from me? Oh, perfect. Okay. And what is the contribution of these SMEs in export, right? I think all of us are aware about how we as a country want to become a 5 trillion economy, right? And exports, for us to reach there, right? Exports need to play a huge role in that. Like, we need to export to about like in the length of $2 trillion. Today we stand at about $330 billion, and SMEs today contribute to about 40 to 50% of that range today, right? But this is where the problem actually lies, right? Like, though the large businesses only contribute 60% of India's exports, right? But the access to credit that they have is about 83% of it. Let me take an example, right? So today, say if banks are giving out 100 rupees, right? These larger players are typically getting 83 rupees out of that, and these smaller SMEs, though they contribute 40%, right? They only get access to 17% of the capital available. Right. And honestly, what has been the problem around this, right? What are the factors that are causing these issues with the SMEs, right? Like GST rollout, right? It's a great way to bring a lot of data digital, right? But honestly, from a SME perspective, a lot of cash has been stuck, right? And like the bank NPAs, right? Like I usually take this example when I present, right? Like, Like today there is someone who's possibly defaulted is easily and happily roaming around on the streets of London, but the ones that are impacted are people like the smaller businesses today, right? And banks have actually gotten very conservative when they're lending. Like today, for them to lend a 100 rupee loan, right, they possibly need to see a collateral of 125 rupees. So all of these factors have actually led to a issue in terms of SMEs getting access to collateral to finance today, right? And what do banks typically look at? They're possibly looking at some collateral. Like banks do not do anything without a collateral, right? And which is an issue at the SME end, right? They're possibly looking at growing the business or in the phase of building a business, so they haven't focused a lot on building a collateral, and which is also not their core, right? And they evaluate a lot on the financial performance of the exporter. They are not going to be funding basis the promise of the exporter in terms of sales that he's possibly wanting to do, but basis his past financial performance, right? And honestly, the problem that he faces today is twofold, right? It's not only getting access to capital from the bank, but it also is from the buyer perspective, right? It's near to become impossible, and given the pandemic today, I'm assuming this is going to get more difficult for the suppliers from India, where buyers typically refuse to pay any kind of advance, right? And I'll possibly take a personal example, right? My dad is into textiles. So he says, hey, any conversation about paying money starts only after 90 days. It's anyways assumed that whatever or anything that's happening today, whatever we sell out, it's only after 90 days we can start hoping to get any money, right? And every business has a peak order season, right? So buyers are very happy to give orders at that point in time. Given the SME does not have access to capital, he has to let go of the business that he could take. So honestly, it's no more about growing, right? It's also about sustenance, right? So let's speak about what like are banks today ready to lend, right? So banks today service a sector where there is collateral, and RBI is also taking steps around this, right? To be honest, but it's near to impossible where a SME today can raise money from these banks, right, without any collateral, right? This is where we come into picture. Honestly, like this is what we feel. One, as I mentioned earlier, like the financial space today is in the early spaces of the late 90s, where internet came in, and a lot of new industries were like the traditional industries were possibly shattered, or possibly new ways came out of it, right? So today, that is where we stand when it comes to factoring, right? A lot of education has happened, but this is where the execution needs to happen today. So what does DRIP offer? DRIP actually offers you collateral free working capital. Like my other fellow speakers spoke about it, we do not focus on collateral, right? The intent is not to look at your collateral and give you money. What we are looking at is the growth of the business, right? Second, it's paperless. Honestly, the bigger problem today, other than having collateral, is the time taken to sign those papers. Like the businessman actually understands cash. He does not understand the processes that possibly banks today have, right? So we are making it completely hassle free. It's going to be paperless. Everything that happens only digitally, right? And automated underwriting. We do not want you to waste like 2 months, 3 months running behind your relationship managers at the bank to raise money, right? We want to give you that facility in a day or two. This is how any normal factoring process works, right? So today, where you would have, like in a general scenario, where you would have waited for 30 days for your buyer to give you money, say 30 days is your credit period, here you don't have to wait for 30 days. The day you ship, the day you have your BL in hand, right, bill of lading, we give you 80% of the money. Okay, and we don't even need the original copies of these documents, right? You just send us the scanned copies. When we say digital, we truly mean digital, right? And the moment your buyer confirms this, that hey, this invoice is good to go, we give you 80% of the money. These are our advantages, right? This is what we actually want to implement to make it easier for you to raise money, right? We give you a credit limit of up to 2.5 million, right? It's as easy as possibly using a WhatsApp or dropping a message. It's just a 2-minute application form. All we need you to possibly remember is your IC code, right? In every literal sales, about zero to minimal paperwork, right? And I think one of the speakers, panelists actually highlighted about the rate that they possibly get at, right? It's honestly as equivalent to what they would get at a bank. And given this is collateralless, we are offering this at about 0.7 to 0.8% per month, right? These are the differences, right? If someone has to actually today compare how does a bank's process work versus how would a factors process work, or how would DRIPS process work today, right? Banks primarily focus, like as it was mentioned, right? Factoring is not their bread and butter, right? They typically focus at someone who's possibly doing a good sales of about 30 to 50 million dollars. Our threshold is very less. We are looking at someone who's doing a business as low as 2 crore rupees, right? Our onboarding, when I say onboarding, it is you signing up to be giving you your first tranche of money. It's less than 5 days as compared to any traditional bank, which takes about a month, right? Literally no paperwork. It's all digital. If you know how to use your email on your mobile, you don't even need access to your laptop, right? There is no collateral required, and we do not actually evaluate you basis your financial performance. Like we evaluate you basis your sales approach, like the sales that you're going to be doing, and the credit worthiness of your buyer, right? I think we've heard this. I'm going to skip this. Just a quick calculation so that all of you guys understand whether this is really costly or this is something that you something that actually makes absolute sense when it comes to doing business. So today, if you're doing a business worth $10,000, if your invoice is $10,000 worth, right, and your credit period is 60 days, right, all you will be paying to us in charges is $140, right? That's like that's about like up 1.5% of your, like if your business is making a profit more than 1.5%, then this is something for you, right? This is, and along with money, like along with access to cash, you get access to getting your business online, right? You get access to knowing what exactly is happening with the business that you're doing, the kind of invoices that are pending, right? So that you don't have to manage it on a ledger. You don't have to go and possibly wait for an accountant to call you to tell, hey, what are the invoices that are due, right? All of this happens online, and you are aware in terms of what is it that is pending. Uh, we are possibly the newest player when it comes to factoring, right? I would not dare say yet the most impactful, right? But yeah, this is what we have done up till now. We have financed about 7,500 crore worth of invoices. We are currently working with 600 plus exporters, and our exporters are spread across. They are possibly in the largest metro in the country, Bombay, to even tier 3 cities like Tirupur or Unja, right? And we work with buyers across 50 odd countries, right? And honestly, this is possibly the most impactful slide that is there, right? This is the growth rate of Indian exports from 2015 to 2018. They have Indian export has grown at about 2.21%. Indian MSMEs have grown at 6.45%. But these are the SMEs that have worked with us, right? They have grown at about 31%. And honestly, there's no rocket science to it. It's about they've just got access to they've just got better access to capital, so they are able to turn the business faster, right? This is where we are present. We work, as I mentioned, we work from the biggest of the cities where our exporters are based out of to smallest of the town. If you're an exporter, if you're doing business, there is access to capital from our end. And trust us when we say this, because we are working with most of your buyer countries, right? I jokingly always say, if you want to sell something to Antarctica as well, we are there, right? We will be able to finance that if you're able to find a buyer there, right? These are the sectors that we work in, pretty much everything. We actually started with FMCG when we started business in about 2016, 2017, right? Today we cover everything from garments to agro commodities to frozen food to chemicals. Perfect. Thank you. Stop sharing. Anu, can you?
Yeah, thank you, Mr. Ishan. This was wonderful session. And now I would like to request Mr. Kishore Pradhan sir to please, as the floor is open, the time is constrained, but floor is open. So we please initiate with the Q&A. You already have certain questions got from the participants I have shared, and there are certain questions with me I may raise once you start with. So please, over to you.
Yeah, thank you, Santosh. Actually, I have a big list of the questions, but time is the key issue. But let me take at least one or two questions which are relevant to you. So my first question is basically to Mr. Sandeep Mahendru. What we are hearing from the market, and you can correct us if you are wrong, that actually it is improving, the trades platforms are improving the payment culture of the corporates. So typically there used to be the delay earlier to the smaller suppliers. Now suppliers are getting the on time payment, they are getting without reverse payment, and on due dates corporates also paying to the trades platforms or the banks which has given the purchase the receivables. So there is a basic cultural improvement from the we always call it a due date payment culture. So that seems to be getting improved day by day. And somebody made a actually comment that if this similar things continues for future for some more years, I think all the supply chain programs of the banks may be taken over by the trades platform. So what's your views about it?
Yes, Kishore, you're right. The delays of repayment on the TREDS platform is next to negligible. There have been few exceptions on some platforms. However, on M1, it has been next to negligible. Even in the COVID time, the finance heads of the various large corporates have been sensitive to make the repayments on time. They have some of them have requested for a few days moratorium, which was granted by the bankers graciously. Having said that, otherwise there is no default or a delay more than 0.5%. On the platform, I mean, in this year we have funded so far we've funded about 7,000 crore. I mean, March 20. 0.5% has been the delay in the default kind of category. So that is the best part. Now, how is the receptivity amongst the corporates to adopt TREDS? I am with you. I mean, many of our clients are migrating their supply chain program from the banks to the TREDS platform, and the primary reason is that they are getting to see the price discovery for every invoice versus when they do a pricing with a bilateral bank, which lasts for 1 year renewal. And here the liquidity is limitless. See, imagine today there are 35 banks. A Japanese bank or a Korean bank who may not have branch banking at every city or an access to every large corporate, he will be able to fund the invoices of a large corporate, vendors of large corporate. So therefore, you get access to banking funds like a marketplace. So really, like a marketplace, you're getting access to the funds. So the power of liquidity is very high, specifically now when the banks and the factoring companies have adopted it in a big way. 2018, 2019, the adoption was step by step. The banks were realizing and seeing the discipline. And now, as I said, every bank has a TREDS desk, which is a very positive development. I mean, and it's a specific team which is focused on it. They have their own objectives to achieve as business objectives that team has. So, whatever is a good rated corporate paper, that gets bidded and settled within minutes. It doesn't even last for a few minutes on the platform. That's a very, very positive thing which is happening.
Yes, thank you, Sandeepji. One more specific questions to you. This is actually a practical difficulty for one of the SME company. This is basically company from Chennai, and they have raised the specific questions that we need to go to the platform where buyer is registered. Now, if you are registered with one trades platform and the buyer is registered with another trades platform, we need to go and do the KYC with another trades platform also. So is there any solution or is there any discussion going on that once typical KYC is being done, like a common KYC, it will be helpful for these suppliers, small suppliers, to trade on all the platforms? I believe there is some discussion going on in the common KYC.
Yeah, so CKYC is the solution. In any case, you're right. Having said that, CKYC is still not on for every kind of an enterprise, and the adoption is very slow. That is being discussed in multiple forums with the regulator as well. Having said that, a pitch has also been made to the regulator that, as the SMEs who are coming on TREDS, they already have a KYC compliant bank account. Now we have to do a KYC again, then it is a repetition that the whole country is doing of a same person KYC, When he's coming from a compliant KYC bank account, he's having a compliant GST number, and now he will be also having an MSME Aadhaar portal, that MSME portal which the government is just setting up, even that will be registered. So once he's satisfying all the three boxes, then do we really need to do the KYC again, or it can be taken as an implied KYC? So that representation has also been made. Hopefully in coming time, these points may get a resolution, and this will become more convenient for the SMEs to participate on multiple platforms. Fortunately, if you look at it, I'm just taking a detour for a second. On one platform, let's say on M1, you are getting a supplier who's now able to do discounting for at least I'm seeing 3 to 4 buyers on one platform itself, which is a big improvement from when such platforms did not exist. So on a single platform, if we can do 3 to 4 buyers, which is definitely a big improvement. However, as you said, if the buyers are on multiple platforms, that is in times to come, it should further get used.
Great. Thank you, sir. Thank you very much. Now I'll coming to the another side of it, and maybe Ravi or Amit or Ishan can answer me. When we talk about the factoring, which is backed by the import factor or the credit insurance, commercial disputes are not covered. So maybe can you give a piece of advice to the participants? How do we actually reduce this commercial dispute so any kind of a dispute will not arise and it will be a smooth transaction? Anybody, Ravi or Amit or Ishan can answer that question.
So, yeah, okay, sure. Thanks for this. Okay. Yes, commercial dispute is a challenge. Okay. Yes, and commercial dispute is something which the seller needs to avoid as well. How does the seller avoid? In most of the exports related transactions, the buyers, increasingly the global buyers, are very conscious of the entire supply chain, because any commercial dispute will arise out of, you can say, a quality or shortage of goods which has been sent out. As we talk about the global supply chains getting more integrated across the world, we are seeing the buyers being more conscious about right sourcing. The right sourcing, it means that they are very careful in selecting the vendors. They go to an extent of nominating to the vendors from where they procure their raw material as well. For example, in auto components, they will go and mandate what sort of material is required, what sort of material vendor is required, and the level of alloys, if at all it is an alloy required. So they are doing a in a sense, by way of reverse engineering to that extent. So most of the suppliers in India are already complying to these norms and are
We can't hear you, Ravi, at all.
We can't hear you.
okay. Now you can hear
we lost the connection, Ravi.
Yeah, can you hear me?
Yeah.
Okay, did you hear me till the other part, earlier part? Okay, so coming, if at all there is a dispute coming in, and that will obviously be coming to the sellers, but there is a way you can manage the dispute if you are able to manage and do a reverse engineering, and your buyers are closely integrated and working with you. The higher disputes are seen largely in case of traders, possibly, or the businesses which is not a continuous basis, or where there would be a consignment or exports not on a continuous basis, not on a continuous order basis, but on a piecemeal basis, or on a particular order basis where the sourcing is done. In that scenario, obviously the arrangement has to be commercially agreed with the buyer, what sorts of valuations is allowed, or what sort of quality disputes will be allowed, and that will finally drill down to the agreements which you have with the buyers. I hope I addressed that.
Yeah. Can I add
Absolutely.
to this further, please? Kishore?
Please, Amit, please go ahead. Please go ahead.
Yeah. Thanks, Ravi. As Ravi rightly pointed out, I would rather like to substantiate it with examples. In the last 20 years or so, the export factoring that we have done, and initially in the first 15 years, it was a tremendous amount of export factoring. Lots and lots of disputes were raised, sir. I would say maybe to the tune of 250, 300 disputes. And out of them, only just one dispute remained unresolved for 30 days and eventually got resolved. So 99.99% of the disputes are resolved. They are basically due to material, the defect of material, or as it could be a shortage of material. And if you are able to, communicate with the import factor, with the seller and the buyer, and all together get to on a forum, it's because, see, the seller, as Ravi rightly says, it's a very important thing. When you have selected the right seller, nowadays what happens, if you know, most of the buyers, they send the quality control people to the export houses and get the material quality checked and verified, and then only the goods are exported. So therein the probability of disputes, it is minimized to a great extent. Even if they arise, they are mostly resolved very, very amicably with the collaboration between import factor, export factor, seller, and the buyer. And just one case was there which was escalated to the higher authorities, and it also got resolved. But it's been a very, very, the product is like that. It will be there, the disputes will be there, but most of them get resolved amicably, peacefully, because now the clients, the buyers themselves are sending quality control teams to the exporters, whether it's for auto industries or for garments. So thereby the dispute itself, the probability is minimized to a great extent. That's what my take is on that. Thank you.
That's really great.
May I ask a question to Mr. Manju?
Yeah, please.
Yes, sir. Yes, sir. Please go ahead.
As you said, sir, this for AAA rated invoices, rate is sub 7 and AA is sub 8. So generally NBFCs have average, even the most blue chip NBFC will have a rating of AAA, but their average cost of fund is around 8%. So will they be excluded from this in participating in this kind of bidding interest?
Yes, Mr. Roy. So the business which is happening on the exchange today is more suited for the bank's credit appetite. And for the NBFC's credit appetite, the business is still not transacting on the exchange because the banks are not taking that credit risk. So there is business available at every price point. And I have been in discussion with a lot of NBFCs that the business is available at the price point at which they want to do that business, and basis their credit risk, that will be available. So plenty of businesses available. Even we are waiting for NBFCs to come over, and that business should get started. Actually, that's sitting on the fence.
Right. Thanks.
Kishore sir, now I have a question to Mr. Ishan Dadi. The question is, as earlier, this drip capital was not in export factoring for the perishable goods. So is it now available or not?
Not yet.
Not yet.
Yeah, so our plans of starting all these sectors, like there are a bunch of sectors that we currently don't do. Perishables, explosives, gems and jewelry, right? We intended to do perishables to start with, right? But like the situation that's possibly come up, right? That's delayed a lot of things for everyone, right? So we still aren't doing perishables, yeah, at this point in time.
Now, while we are going to closing this of this program, the basic question is again there from some of the participants who asks, what is the basic requirement to MSME seller to avail factoring, and what is the basic requirement for customers to avail factoring? So Is there anyone of you who can explain in a simplified language that can make him understand?
Well,
I would request
possibly I'll take
either
the
of
first stab. Yeah, I'll possibly go ahead and take the first stab at this. Right. I know possibly the way it comes across, it's complicated. No, honestly, it's very simple, right? I'll tell you the most basic requirements for you to avail factoring from possibly any one of us, right? Maybe there'll be some rules that might vary, right? That all of us might have. I'll possibly speak about DRIP, right? In general, right? We expect you to be an exporter, right? First requirement. Second, you need to be exporting in the last 6 months or even 1 year. The value of export should be about $300,000, right? That is 2.1 crore rupees as per today, right? That is your only eligibility for you to avail finance from us, right? And yeah, sectors possibly you should not be doing perishable, explosives, gems and jewelries, right? Other than that, you are an exporter who sells anything and everything from garments to meat to anything. We are happy to fund those invoices, right? And from your buyer perspective, I don't think there is a lot of role that possibly you could play in that, right? It is basically the insurance coverage that's available for them, and don't worry, we'll do that for you, right? And you will have an answer from us in about 48 hours whether whether we have the insurance on the buyer or not, right? So yeah, so that is a requirement for you to avail finance or factoring from us, right? I think, yeah, I hope this helps.
Ravi, you want to add something?
More or less, this is what, as Ishan said, more or less, it's something similar. Possibly, the variants might be there. There might be a few more criteria or a few more requirements from a domestic point of view, that you need to be selling to a higher rated corporate, or you need to have a sufficient track record for selling to the buyers, and the possibility of, having, sales across possibly a couple of years to establish the track record. As, we initially mentioned that the reliance is more on the performance sales ledger for past few years rather than completely on the balance sheet. So if you have a track record with the buyer, this is a key enabler for us, for the factoring companies to assess and allow you the limits.
Can I just mention
that's
that?
great.
Sorry, I just want to just mention, just to add to what Mr. Ishan and Ravi just said. We did a study, I think it was 2018, with this was just in Europe, but just to give you an idea, because it's 2/3 of the global industry, 70% of all the clients that use factoring are defined as SMEs, and this is a fact, and we have proof. So you can translate that to say globally. Certainly, our business touches SMEs more than any other corporate, any other type of business. And why? Because, again, it's the easiest way for an SME to get funded. And it is, as Mr. Ishan really explained well, very easy for a company to be able to liquidate their receivables off their balance sheet, both domestic and international. We highly encourage all of the SMEs to, talk to all of our members and companies on the phone on this webinar today. Thank you.
Great. Over to you, Santosh ji. I think we have already crossed our time limit, so I will hand it over to you.
So now, thank you very much. Thank you very much to. I would like to extend heartiest thanks to Sudarshan Sen sir for giving us enough time and being available for this whole, entire session of this factoring summit. Likewise earlier, and we are grateful to you, sir. We are also thankful to Mr. Peter Mulroy for taking out time from your, holidays and making this session to be a successfully conducted. And I would also extend the thanks to Mr. Vikas Kanti Roy, Managing Director, IFC Factors Limited, for having you with us, sir, and supporting us this particular, webinar, Global Summit, as a sponsor from IFC Factors as well, as a key sponsor. And I would like to thanks to Mr. Ravi Blecha ji Mr. Amit Kaul, Mr. Sandeep Mahindruji, Mr. Ishan, and last but not least, Kishore Pradhan sir. Thanks to you, sir, and all the participants who have been throughout this session, and still they are waiting that something good will come out of this. And I'm sure that this factoring as a product would be taking off in a new fashion altogether. And from ASSOCHAM, I can assure that all the stakeholders, wherever they feel that ASSOCHAM can be useful for them to put in place their recommendations, suggestions to the regulators, which may bring out certain change, we are already welcoming them. We request that please put up your papers and suggestions, recommendations, come what may, and particularly regarding those lines which Sudarshan Sen sir has himself, given the suggestions to the industry, to the stakeholders, that would be a lot of change making. And thank you very much, all of you, for making this particular, virtual webinar, virtual summit a great success, in terms that the participation was great, and some of the people, due to the connectivity issue or some other, they have been keeping requests, sending requests to us that please share this video. So we assure you that please, we will make this video available throughout these platforms like LinkedIn, like Twitter, like all the Facebook and YouTube. You will be available, able to see these videos every time, and whenever you feel that we are required to further serve you in whatever manner, we welcome you, sir. We welcome you all for sparing your enough time. Thank you so much.
Thank you, Mr. Mulroy, and thank you, Mr. Sen, as well.
Thank you very much.
Kishore and all the participants and Santosh. Thank you so much.
Thank you so much. Thank you so much, sir.
Thank you.
Thank you, everyone.
Thank you, everybody.
Take care.
Thanks. Bye.
Have a great day. Bye.